Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia Pacific on the back foot to kick off a, fairly busy week. As far as markets go, traders are sweating whether the Fed will deliver a widely anticipated rate cut.
U.S.-China talks in Spain head for a second day as Beijing takes aim at U.S. chips. TikTok also in focus with the clock running out on a deal over its U.S. operations.
And Chinese stocks coming off their best year in half a year as traders looking for fresh catalysts for August economic data due in the next hour. Good morning. Happy Monday. Fresh trading week ahead. We have to underscore the point that we've over-obsessed with to date, a central bank extravaganza ahead, of course, the Bank of England, the BOJ. I haven't mentioned the Fed. Oh, there we go. Okay. Asia-Pacific benchmark. We're closed in Japan today, so we're looking at the ex-Japan gauge, although that being said, of course, a lot of strands in there to note. 4.10 to 1% over in South Korea. Market is coming in Taiwan. We'll talk more about the chip investigations going on, of course, as it pertains to China. Of course, as far as South Korea goes, the big story there was authorities and regulators scrapping this plan to raise CGT. Of course, we'll get to that in a moment. Of course, Fed unchanged. The other side really to an S&P at these levels is really a VIX that has remained chained to 15. In fact, VIX futures are coming up on your screens. The dollar, which has been weaker, although that said, if you take a look at the chart of about 2 or 3 months or so, that rally's actually stalled to the downside, right? We have been range bound at the bottom. What will be the catalyst, if any, for further bond selling again? Gold futures are coming off a little bit after just last week. Of course, the big headline there is gold topping its 1980 inflation-adjusted peak. Right. Going into the open today, we just mentioned at the top of the show, Chinese markets are coming off the best week on MSCI China specifically. Going back to early March, Golden Dragon Index on Friday. A couple of stocks were tracking going into the open today. Of course, the big one, the other big story today, of course, this week is Hesai listing and the debut here in Hong Kong. We'll be tracking Baidu, of course, going into the open today. The other thing I want to mention, not on your screens, is Tencent. About an hour back, the company just putting out this information here, more on this in a moment, that it is looking to raise money in the bond markets for the first time, thank you so much, in 4 years. It's now appointed banks to start, calling people effectively. And we'll see what the deal is all about, and we'll see how large the deal actually is. In fact, here's the first plug of the week for you guys as we look into the futures trade today. Our taking stock piece today really talks about how this red-hot equity market has really been a boon for fundraising, right? Whether that's Alibaba, we talked about that. Tencent, of course, is a debt capital market, start to fund the growth story ahead. A50 futures are flat going into the open today. And, of course, conversations around bond buying, question mark. We'll talk more about the 10-year yield in a moment. 11 days, of course, of southbound flows. I haven't even mentioned data. Of course, that's a big one. Okay.
And we'll see, right, if the data does anything, right? We're expecting some weakness when it comes to that August print, whether it's the data down, the home price data that comes out at the bottom of this hour as well. So that certainly is the next thing to watch. But, will it just add to this dichotomy of weak macro and actually liquidity-filled markets? That certainly is set to be the case here today. Day two of course, Madrid talks there. We'll see what happens. And does it set us up for some sort of Beijing summit ahead of that APEC meeting in South Korea? That's the key focus there for the market. We talked about the data dump. That JPMorgan Mart call, so downgrading the stock to neutral. We'll talk it through that, but upgrading CATL to overweight as well. Southbound flows, as Dave mentioned there, and we're focusing on chips. We're focusing on the auto sector here this morning. But yeah, it brings us to kind of a lot at stake this week, right? When you talk about what the global 36-hour central bank spree that we're going to see, right? I think it's like half of the world's top traded currencies are going to be reacting to some big central bank decisions already. Yeah, and
as far as the Fed goes, right, we're fully priced for the cut. And I think the question there, and I think our preview piece on that really outlines it very nicely. Will they push back on what else is priced for the year, which is closer to 3? whether that's data dependent.
And deep into 2026.
Yeah.
Enough to, some say, even fend off a recession. So is Jay Powell going to push back on that in some ways? Because I think from a trader's perspective, I think this cut is basically a done deal. It's really how many more they're going to see. And the dots are going to be quite crucial this time around.
Yeah, we'll watch that very closely. As you can see, of course, it's central bank extravaganza and really where you will be getting great decisions this week as far as that's concerned. We talk about Japan, of course. That's towards the end of this week, I believe, as well. The other thing we want to talk about is, of course, we're now we're coming off the best week for equity markets in China in about 6 months or so. And what that's done is that's actually lifted. It underscores the re-rating that this market has applied on this market. And I think we're now trading at 12 times earnings. And I think JPMorgan will be coming on the show and they'll be talking about what part of the market rally looks frothy, what do you chase? Because at some point you'll be looking for earnings, right, to bring this ratio back down.
Wendy did mention in this latest note, right, anti-involution and how it's making its way through, earnings and the like. She's started to see things revert a little bit, whether it's, discounts in the auto sector, solar, e-commerce, for example, where you're starting to see a little bit of recovery there, and things are looking better since July. So that's currently why. But I think Winnie Wu from Bank of America just a few days ago did mention, right, AI is going to be what's going to lead to re-rating in stocks overall. And I think Alibaba has been really front and center in that. And they're becoming the leader, really, in this whole AI race in China.
Yeah, and that's really one name we'll be tracking going into the open today because that trade is back, right?
Yeah.
BAT, Baidu, Alibaba, and now Tencent, of course, given the fundraising there. And, of course, the other thing today is it's now day 2 of the trade talks coming through TikTok and, of course, Madrid. They spoke on Sunday, and we'll see whether that conversation gains even further traction, putting us maybe on track here for late October, perhaps early November. We'll see whether or not how busy we'll be at that point in time. Speaking of that top story, let's get to that right now. So you have these meetings, of course, covering issues, wide-ranging issues, trade, TikTok, the fate of TikTok in the U.S. You have President Trump saying the talks are going fine, but that the fates of the company, TikTok specifically, will be determined by Beijing's actions.
They're negotiating TikTok right now. We may let it die, or we may, I don't know, it depends, up to China. It doesn't matter too much. I'd like to do it for the kids that like it. I mean, selfishly speaking, I did very well on TikTok, and I got the youth vote.
All right, let's bring in Stephen Engel, our Chief North Asia correspondent, here about what we know about, give us more context, and of course the trade conversations. Day 2 today.
Yeah, I think the big question is why was TikTok pushed to sort of the top of the agenda, at least for the United States? Because there's a deadline of this week where they need to find a deal. They need to find a U.S. partner, a buyer, basically, and China needs to, as well, agree to sell the U.S. division of, TikTok, thank you very much. So the clock is ticking. It's also something that could potentially be a deliverable for an upcoming meeting between Xi and Trump. And it's a fairly easy deal compared to any major progress on the trade front or on national security issues, which were also on the agenda of the talks yesterday and again today in Madrid. So in lieu of major progress on the trade front and tariffs, aside from perhaps another extension. Keep in mind that latest extension expires November 10th. So after any potential meeting between Xi and Trump, whether it's on the sidelines of APEC in Korea at the end of next month, maybe in between ASEAN and APEC, or in China itself, there needs to be groundwork laid for that trip for both leaders to have some sort of deliverable.
Yeah.
Right? So TikTok, I think, has probably been pushed up because of the deadline this week, whether it's going to be kicked down the road or whether they're going to announce some sort of deal, or as Donald Trump just said, we might just let it die, right? That's not really a great deliverable, right, to those voters that he just cited, right?
And the talks could have gotten off to a rocky start with China announcing 2 investigations into the U.S. semiconductor industry. What details do we have of that?
Yeah, that's right. So ahead of these talks in Spain, you had, first of all, you had the United States adding 32 companies, including 23 Chinese companies, to its so-called entities list, which you gain entry to that list if your company's actions are deemed to be counter U.S. foreign policy or the interests of national security. So they added 23 new Chinese companies, including Shanghai Fudan microelectronics and also Sino-IC technology, among others. And then the U.S. did that action. And then Saturday, before the talks started, you saw China basically announce, the Ministry of Commerce announced 2 new investigations. One, an anti-dumping probe into certain U.S.-made analog IC chips. They're not the highest-end technology, but they're in everything, from electric vehicles and smartphones to medical imaging, lots of different products. So that could potentially be a bugaboo for U.S.-China relations. But then there's a broader investigation also been launched, anti-discrimination investigation into U.S. moves against the Chinese chip sector. So we'll have to see what that actually entails. But again, it could have gotten off to a rough start, but in the end, He Lifeng meeting with Scott Bessent and Jamieson Greer, the U.S. Trade Representative, for more or almost 6 hours. And again, Scott Bessent essentially, as talks ended yesterday, gave an indication that talks would resume first thing in the morning Monday.
All right, Steve, thank you. Steve Ingles, our chief Malaysia correspondent there with the latest. And coming up, we're going to dive into the market's outlook with, of course, Wendy Liu, JPMorgan's chief China equity strategist as well, talking all things anti-evolution, consumption, and overseas expansion and the like there with her latest report. We're counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show.
All right, we're coming off a big week for Chinese markets last week. We were up 5% on MSCI China. And of course, as it pertains to some of the benchmarks onshore, I think we're still near 10-year highs. On the Shanghai Comp, we're near 3-4-year highs on the CSI, China Next Index, MSCI China, 26,000 and change, of course, on the Hang Seng Index. Yeah, so what's next? Activity numbers, earnings. Once we're done with the earnings season, once we look ahead, of course, what happens here, how do we look at valuations is the point at this point in time. Wendy Liu is joining us right now, Chief China Equity Strategist at JPMorgan, to just help out map out this week for us. Wendy, nice to see you. And yeah, I mean, who have been the buyers of the recent leg of the rally? Is there foreign participation now? I guess is a question there.
We look at the flows. There are essentially 2 types of dynamics. One is the onshore, the other one is the offshore.
Yeah.
You could see that offshore continue to cover their underweights. So there are 4 types of major funds that have exposure to China because the benchmark to MSCI indices. And among the 4 of them, EM has been narrowing the underweight the earliest.
EM funds?
Yeah,
okay.
They have been very early. I think Asia-related funds, regional funds, they've been rapidly narrowing that underweight. Global actually has done a lot. I think it's simple for global because you only need 5 to 6 stocks, and they tend to know which those stocks are.
Yep.
And what's been lagging based on EPFR data for end of July has been global ex-US, where the benchmark is about 8%ish, and so you need more than 4, 5, 6 stocks. That's taking a little bit longer. And in the aggregate, it's about 4.6 trillion AUM, and where China's weight is about 8%,
okay.
8+.
So you're still expecting CSI 300 has room to have 20% returns by the end of 2026. How do we get there?
Yeah, okay.
Wait, is it 20 from now or 20
end
from...
of 2026.
Yeah.
From the start of this year?
End of 2026.
Okay. From
this year, I think it's more likely to be a bit of a consolidation because the earnings. So we look at the earnings estimate. CSI 300 actually has a little bit of downside, possibly for 2025. The top-down estimate is at about 8%, 8 to 9% for this year.
Okay.
Bottom-up index weighted is more like 14. And then the run rate based on Q1 and Q2, that's 9% and 3%. So whichever they need to hit, there's a lot of room to cover. But if I look at the FTM, forward 12 months EPS, it's up 6% vis-a-vis September of last year's level. So it's a push out of earnings into 2026. And it's very clear in 2Q results, all the sectors with evolution, they did have undesirable results. Yeah. Quick commerce, home delivery platform being one, logistic being another one, auto being major ones, and liquor also. But then since the anti-involution call policy pivot on July 1st, pricing started to recover. So that does give people some confidence that by 2026, the numbers are not going to be that bad. So that 20+% upside is based on hitting consensus number, okay? And at the peak of the cycle, generally, the PE will be at 2 standard deviation above the 10-year mean. So with that, we can get to 53.30 on CSI 300. And so that's the math. But I think way beyond 2 standard deviation is difficult to do. And right now, I think the market's kind of ahead of what the JPMorgan quantitative macro indicator would suggest that it should be. And so I think people are waiting for macro data to come in and earnings to come in.
Okay. Yeah, I mean, the anti-involution exercise is starting to become a slow burn rather than a big bazooka. I mean, to your point, right? The earnings are starting to move, but we might have to wait 16, 18 months before that actually shows up. What specific sectors do you think will lead that 20% going into the end of next year? Where will earnings start to recover quicker than others?
Yeah. So the one sector that has responded already with EPS upgrade has been materials. Materials have been the single biggest beneficiary of anti-involutionary. So we look at GICS level 2 return year to date. Best is biotech, but then right after that is materials. And within materials, there are 2 buckets. The one bucket is related to the renewables. The other bucket is related to the property ecosystem. And the renewables have responded the best. So these are the batteries, solar-related polysilicon, and then, related materials, for example. And so people do see the renewables as having a better combination of top-line growth profile. And then if there's less production, less investment, then pricing could recover more. So I think that's what's driving the favorable view for this side of the material space. For the property proxies, and plus some of the macro-sensitive verticals like coal and steel and then cement, etc. I think there is appetite for things to recover, but overwhelming secular trend is still weak.
And which is the next one to watch after materials? In this whole anti-involution theme.
The couple sectors that have been hurt a lot. One is logistics. And the logistic ASP in July and August, the decline year over year has narrowed. So that's one thing. And within the broader consumer space, the bigger one is clearly the quick delivery platform. But I think companies are making decisions for their strategic goals, their market shares in a couple years' time. But if there are signs of reduced competition, that's going to have very large market impact. And there are smaller segments like dairy, liquor. So competing over price and grabbing market share has been this standard approach for competition in China. And anti-involution is just a mindset shift in favor of return on investment because it's an ex-growth world. And so I actually think the next decade will be about consolidation. So the top line growth will come from stable ASP and market share gain. So it's quite different vis-a-vis what we had before.
Well, I mean, is that another way of saying earnings won't be as relevant? Won't PE be as relevant because it's an ex-growth world? Because right now, and I'm going to mention some names, you don't have to talk about them specifically, but I can think of Meituan, for example, one case. You have BYD on another. The markets seem to be looking at those plays and saying, gone were the days where you pick the number one in that sector, and that's enough to give you alpha, right? Clearly, markets are moving beyond the top 1 or 2 names and saying the top 1 or 2 names, in fact, might take a back seat to to this conversation around competition. So how do I now look at who the possible winners are in an ex-growth sort of context?
Yeah. I think there are situations where competition come from outside the current vertical, and there are situations where the pricing power across the supply chain may change. So those are the things to be focused on. And I think critically is looking at whether the company can produce the revenue that can allow earnings to come through. And there are regulatory shifts. I think in the auto sector, people do pay attention to will the subsidy continue, right? What's going to happen to the vehicle purchase taxes? Are there going to be some sort of equalization between the NEVs and ICEs? I think there are a lot of unanswered questions. But there are segments within this broad auto space which seem to be more resilient and more poised to benefit. So I think it's relative pricing power and revenue growth.
Wendy, we'll have more from Wendy Liu from JPMorgan there, and some of her top picks coming up as well. In terms of the pre-market, we are seeing futures slightly to the upside here today on this Monday morning as we count down to some key data. Home prices in about 7 minutes or so, and that data dump at the top of the hour. We got plenty more ahead. This is Bloomberg. All right, we're tracking, of course, tech stocks here in general. Tencent is up slightly here. So we're hearing that they have appointed some banks for its first bond sale in 4 years. Not sure the amount, but certainly is another one joining in terms of the tech space and raising money. Take a look at Pop Mart, though. Interesting call from JPMorgan, now downgrading it to neutral and cutting its price target to 300. Now, they're saying lack of catalyst now. I think 4 of the 7, or there was 7 that they had, where we've recently reached most of them. The other last 3, according to Kevin Yin and his team, is now a bit harder to say because there's not just low visibility right now, but overall price for perfection, they say, for the stock right
Release of animation is the 4th. Launch of Labubu 4.0 is number 5.
Yes.
And the introduction of interactive toys is number 7. Yeah. So it's, price for perfection is the one. So any small bad news might be treated as a big deal for markets. Anything,
right? When it comes to many Labubus in the secondary market where prices are sinking some 20% or so, right? So certainly I want to watch shares down some 3% here today. And watching the chip space, so the Huahongs, the SMICs, the Capricorns here today. There you go. China started that probe targeting the U.S. chip sector here. That seems to be helping some of these domestic players. We mentioned Silergy listed in Taiwan. That was also up substantially this morning as well. Yeah,
we're seeing 10% on that. The opening bell is just a hedge, just over 3 minutes away. Keep it here with us. This is the China Show. Good morning. Right, good morning. And you know what? It's a beautiful weather on the weekend, beautiful weather in Shanghai, here in Hong Kong. It reminds me of that, the calendar month actually is a good indication of that, right? It's the Earth, Wind, and Fire, right? September. People on the beach, a bit of earth. People out on their boats, a bit of wind.
Yeah.
People out exercising, and there's humidity, a bit of fire.
Yeah.
You think about it that way. And will Jay Powell give us something to remember this very first night of September?
Do you remember? Yeah. Yes, it's a great month. It's my favorite. It's my favorite one of the year, obviously. But there's a lot. Hang on, whether he's going to push back on the market pricing, right? I believe markets right now are pricing in a cut every single meeting up into the end of the year and deep into 2026. So what are the dots going to show? That's going to be a big crucial point for the market here. And really, is he doing it because he wants to fulfill that dual mandate? BE says, nah, not really. It's maybe in some ways to appease the government in some ways when it comes to where they want, and a Fed that potentially could be leaning more on the dovish side as well. Take a look at how onshore markets are doing, and we're doing decently well. We're up about 1/3 of 1%. As Dave mentioned, the CSI 300, we did reach the best week in 6 months.
MSCI China.
Sorry, MSCI China.
Yes.
Thank you for correcting me. But yeah, so offshore markets were doing quite well. That is thanks, of course, to the likes of Alibaba and the tech space there all week, talking about this whole, raising money in the market and tapping the market and the like. So there you go. Right now, we're focusing focusing on CATL shares, they're up 7%. JPMorgan coming out with a downgrade for the stock overall. We'll talk about that a little bit later on. But the domestic chip players are doing quite well, the likes of Cambricon Tech. We talked about Silergy, that's listed in Taiwan as well. And SMIC, Hua Hong on the back of China announcing this probe on U.S. semiconductor chips as well. So here is Hong Kong doing less favorably. We're down about a third of 1% here today. HS Tech is slightly on offer. So not huge moves, but you're seeing the likes of Baidu is down 2.5% or so. Meituan is slightly to the downside there, but the 8 shares of CATL are doing quite well. We're up some 5%, similar to what we saw in the A shares. So certainly that's certainly one thing to watch. Yeah. So raised overweight from JPMorgan. That's certainly one maybe potential catalyst there as well. Mart could be the other story, right? So what we saw from JPMorgan is also downgrading the stock to neutral, saying, basically it's been priced to perfection, and any sort of incremental news, bad news, could maybe lead to a trigger for the stock to downside here today, just given the fact that we've already seen most of the catalysts materialize. Maybe if there's like 3 more that could be a bit harder to attain. So there you go. Price target at $300 right now. We talked about China chip stocks, so certainly that's one part in the market that still continues to do well. There you go. SJ Micro is up 20%. On the back of this probe and investigation that China has, as we, of course, count down to day 2 of U.S.-China trade talks in Spain. And does that lead to some sort of meeting between President Trump and Xi at APEC? Even before that, will we see some sort of Beijing summit where Trump heads to the mainland before APEC?
Yeah, okay.
Auto stocks, sorry.
We're looking at auto stocks because, I think it was out on the weekend. Let me just look at that statement here coming through. So as the market tries to keep up with this lengthening list of sectors where there is some version of the anti-involution campaign that is set to take hold, China plans to stabilize the car industry growth. That was a statement coming out of the Ministry of Industry, MIIT, effectively. Hidden below this, and part of the details, is regulators will conditionally approve the production of level 3 autonomous vehicles, otherwise known as conditional automation. That's one to watch on the back of, I think, news in recent weeks, and the big one was BYD cutting their annual sales target because of, I guess, with a few months left, it doesn't look like they'll need almost near perfect, if not perfect, fourth quarter to be able to beat those goals. We'll talk more about this later. Right. Okay. Home price numbers coming through. This is for August, and we're looking at negative 0.3%. That's month on month, which is similar to the drop that we had back in July. In fact, slightly smaller. If you look at the more encouraging side of this, the July print was negative 0.31. This one was negative 0.30. And this all comes ahead of the activity numbers, which should be out in about 27 minutes from now. So in other words, no change as far as this specific story is concerned. Okay, other things we want to talk about here. Let's have a look at some of these markets too. Okay, can we get a preview, guys? Do we have a preview graphic? I want to talk about the activity numbers that are coming through at the top of the next hour, right? So our folks at Bloomberg Economics actually think that they're actually way below median on the retail sales numbers. So they actually think there's going to be substantial payback there.
Yeah, it seems like things might look better headline speaking, but I think underneath the hood, that's the thing that they need to worry more about. So certainly that brings us to a lot of discussion about this whole consumption trade that we're seeing across these markets, right?
Yes.
Emotional sort of economy or emotional sort of consumption, people say, right? That seems to be where we're still seeing bright spots in the consumption space.
It's $1 trillion retail market, right? So, markets, and I think it depends who you ask. If you ask your traditional dollar-based overseas investor, if they're looking what draws them to the Chinese market, it used to be growth. Should it still be growth as the main catalyst there? Because if you ask domestic funds, they're really playing on thematics, AI, anti-involution. So people are making money in this market. And foreign investors might be looking at the wrong metrics here when they look at whether or not to get into this Chinese market.
Yeah. Wendy Liu, she's still with us, Chief China Equity Strategist at JPMorgan. So how do you see, is that what Dave mentioned there, that foreign investors are maybe kind of missing the picture here when there are so many different themes out there to really sink your teeth into in this market?
Yeah, I think that's right on the money. I think for asset allocators that need to look at the macro and assess what are the risks on the macro level, the property drag and then growth. Is it further softening? Is it going to stabilize? Macro numbers are very important, and that's probably preventing some of the investors from more assertive allocation. But I think for the active investors, thematic investors, this has to be a tremendous opportunity because relative to the quality, valuation isn't that expensive. Yeah.
We were having this conversation during the break. You're making comparisons to 2015. Well, most in the market have been making comparisons to 2015, and you saying that's really not the best way to gauge whether or not there are signs of over-exuberance in this market. Tell us why that's not a good comparison.
I was covering the market back in 2015. It was just a mad bull market. This one is very different. It's very much institutional driven. So we track the onshore flows quite a bit. And the flows that represent insurance purchases and national team purchase tends to come in at 12. And they've been selling. Year to date, they've been, the flow we could see, and the trimming has started as, throughout this quarter. So retail back in 2015 was unharnessed, and this time is harnessed. So retail is very, very powerful, and they tend to come in at the tail end of any rally. So the trick is to temper that enthusiasm, and so this rally.
Just so the bull market doesn't end.
Yeah, and so I think, given that institutions care about macro data, care about EPS, so I think this sort of a rally will be more step-like. Be calibrated on the fundamentals. So I think it's becoming a more mature market. And back to the metrics, I wouldn't be looking at margin bias percent of turnover vis-a-vis 2015. It's really X 2015. So we know that if it's 11%, 12%, then it became overbought and it pulls back, and which is what happened since end August.
We mentioned this whole kind of market of consumption, new consumption, for example. You said you focus on more experience type of consumption. Why?
So we know the younger generation, they like to consume, but they also seek out things that are more content-driven. Okay, so concerts, they've been gravitating toward that. Travel, they've been gravitating toward that. Digital content, and that's really benefited home entertainment space and the Macau space. And this seems to be continuing. I think that has somewhat to do with the social media. You go to a concert, you post it on Instagram, or and then it's a way to build the a fan circle. And then it's also about supply and demand. In analyzing U.S. PCE breakdown and Chinese urban and township consumption, X the FX conversion, there's not that much difference between U.S. and China township, urban, on food, clothing, housing even. The differences are in the service sector. You would have education, entertainment, culture, where things are different. But given that there is a public service angle to housing, education, and then healthcare, we wanted to seek out where things are scarce in supply and invest in those. So we kind of stayed away from investing in merchandise, but investing more in experience-based names. And the other thing to check out on the merchandise is looking at what China exports to the U.S. and what China consumes at home. And there are three categories where the ratio of export vis-a-vis home market consumption is just too high. Electronics, appliances, what China exports to the U.S. in 24 is 100% of what it sells at home.
Right.
And the other one is furniture. So the furniture and furnishing space also at 100%, and it's been struggling quite a bit. And then last, footwear, apparel. So I just don't see tremendous pricing power for those three sectors given the supply dynamics. But on culture, education, entertainment-related sectors, I think there's scope for volume growth and ASP increases.
Okay. So where you have the high ratio, to your point, things like footwear, for example, high ratio of exports to domestic consumption. That's a good metric for consumption, just to clarify conceptually what that means. So when I look at supply and demand on those themes and look at it domestically, so you mentioned services, things like that, where are those names more? Are they listed offshore, or are they more a share marketplace for asset allocators?
I think Macau clearly listed here.
Okay. Yeah. Okay.
And then education is listed in U.S. and also here. Healthcare services, there are quite a few listed onshore, and then entertainment and media, more of them, way more of them are listed here.
Okay.
Yeah, in Hong Kong.
Yeah.
And U.S. Yeah.
There we go. Wendy, thank you so much. That was Wendy's way of dancing around the actual names, but yeah, effectively telling us. You know what those names are. There we go. You can simply look at those markets. Wendy Liu, thank you so much. Chief China Equity Strategist there at JPMorgan. So in about 18 minutes and 10 seconds, we should be getting the activity numbers coming through. And subscribers can also turn to the terminal for more on this TLI Vigo. A blog will be ongoing shortly, if not already. Commentary, analysis, and context around the breaking numbers, which are set to come out, of course, in about 18 minutes or so. So we'll be back shortly. Take a short break. See you in a while. This is Bloomberg. Good. It seems like you're there.
Happily talk about the Fed. I don't think there's anything.
All right, shaping up to be a busy week, especially for central banks. Yeah, we got a special guest coming on. So we're talking about the Fed, obviously, but look at what's happening, right? So we talked about, so many central banks are meeting here. Perhaps probably the more major ones like the Fed, BOE, BOJ are all kind of reporting and announcing their rate decisions there in the last 3 days of the week. Before that, though, obviously we have that He to be here in Hong Kong. That's going to be a big one as well. Activity data coming out. That's going to be the next one there in just about 15 minutes time. But yeah, it brings a lot of discussions on really how many more cuts are coming. I think if they don't cut, obviously this week is going to be crazy for the markets, which people don't really expect. But it's really how they're going to telegraph the remaining few meetings too.
Yeah, well, if you ask the markets how many cuts are priced, it's 3 for the rest of this year. You have a couple of more going into next year. But that was the point really out of Eric Robertson and his team. Because to what extent will Powell and his crew endorse anything beyond today's meeting, and to what extent will he then pull back on the 3-cut expectations, right? And perhaps that is why Eric Robertson and his team have put out this piece on the weekend. It's really part of Yvonne and I's weekly reading. Why has the dollar decline stalled? And if you look at it, we have been trading at the low end of the 2-month range, but as you can see, you look at one-year forwards, for example, and to him that indicates that the cuts might have been priced in. You look at dollar-yen, for example, which has remained steady despite the fact that you have had a substantial disappearance of about 250 basis points of rate premium on the 2-year U.S. and Japan. And to the point Eric is making here, perhaps the markets are just waiting really for the Fed chair to just be more dovish before taking the dollar, in fact, even lower. Now, as we were just pointing out there, the Fed is poised to, of course, resume cutting interest rates as it grapples with a slowing labor market. You have stubborn inflation, of course, which is a complication there. Let's get more. Joining us here on set is John Authers, our senior editor for Markets and Opinion columnist as well. John, it's nice to see you in the region.
It's great to be here. Sorry, I'm a bit jet lagged, but I will try to be. I will try to be as sharp as I can.
You'll be fine, I'm sure. What do you think the Fed's going to tell us?
Well, the Fed is going to cut probably by 25 basis points. I don't think Powell is a naturally cautious person. I doubt they would go for a 50 because the inflation numbers really don't tend to permit that. I think it will be an all options open. I don't think we're going to get a really clear dovish steer. I doubt it'll be a particularly hawkish cut either. I don't think there'll be a clear sign that's your lot. So much we still need to find out about whether those tariffs begin to feed through into inflation. They are feeding through into inflation in a very small way thus far, but it's plainly there at the margin. It's not tariff derangement syndrome, as Stephen Miran, who will be having a vote in this meeting, has described it to be worried about that. It's absolute economics 101 that's something you need to be concerned about. So I doubt that they will strongly commit to the likely next 2 rate cuts. at this next meeting. I think they'll leave their options open.
Yeah, there's a lot of questions on what we're going to hear in the statement, whether it's going to focus more on the labor market, whether it's going to focus more on inflation. You wrote in your latest column that the Fed is doing what it's been told and fulfilling its actual dual mandate, but not wisely. Why not?
Well, there was a phrase from Othello after he's killed Desdemona and discovered that she hadn't actually been unfaithful to him, that he had loved not wisely but too well. What struck me is that if you look at, there's actually a triple mandate. They're required to maintain inflation and full unemployment and moderate long-term interest rates, which you tend not to think of as the third mandate because it goes so naturally with keeping inflation under control. But if you look at those three in combination, we have had for the last year or so one of the few times when all three of them have been below their historical average. And in general, for the last 25 years, which is the period when disenchantment has steadily picked up in the US, people have got ever less happy about the economy, the Fed's actually been hitting its mandate beautifully. It's all of those three measures, obviously with a significant but not that lengthy exception when they let inflation get out of control after the pandemic, have basically been under control for 25 years. And as you can see, we wouldn't have had two Trump election victories if people were happy with the results. So in terms of the very big battle that's now going on, the political battle over the independence of the Fed, the role of the Fed, I think it's quite important to recognise that it's not necessarily that the Fed is expanding its mandate or doing mission creep. It's frankly, if you don't like the inequality that is resulting all these various issues, which are obviously very real, very painful, you don't necessarily blame the Fed for doing that because the Fed is doing what it's told. You actually need to change its mandate. You need to, or you need to ask it to do even more. And obviously, when you're getting into such things as who wins and who loses in society, redistribution, that's very much the kind of thing that it really has to be a democratically elected politician rather than, a nerdy economist, central banker who makes that decision.
That's a good point, because it's almost like, and I'll use just thought about it now, it's almost like an AI analogy. The Fed was programmed in a certain way.
Yes.
You almost wanted to develop some sort of internal inference to be able to make things out in what that new mandate is. Almost like you want it to be agentic AI.
Yes.
Do we need to think about the mandate then? Like, what does that mandate need to look like to be able to meet that new reality?
Well, the most obvious alteration, but again, this would be weird given that this last US election was in, if you believe the polls, probably decided more than anything else by people's anger about inflation taking off. The single most obvious alteration would be to allow them to be more liberal about inflation, to give up on 2%, talk more in terms of 3%. That begins to give you a lot more give to try to make the people at the worst end of the income spectrum a little better off. Obviously, there are many problems with doing that. That's the most obvious way to give that I can see. The other possibility that I find quite alarming, because historic precedents aren't that clear, is to actually emphasise the borrowing costs, which is the third part of the mandate, moderate long-term rates, which is obviously what President Trump would like at the moment. And again, if you make it easier for the government to borrow as much as it likes, then it becomes much easier to do the kinds of things that relieve poverty. We do also know that it does also involve forcing people to lend to the government at uneconomic rates, and it brings with it the risk of inflation. Those, I think, are the two clearest possibilities. They're beyond our pay grade as journalists and perhaps beyond the pay grade of central bankers to really... You need somebody who has been elected with a mandate from the voters, to say this is what the central bank needs to do and to accept that it's different. You've done what we asked you to do, and now we realise we don't actually like the result.
John, it's great to have you here.
It's great to be here.
Our Bloomberg senior editor for markets and opinion columnist, John Author's there. Subscribers, you can also check out his latest column on the terminal and on Bloomberg.com. We got plenty more ahead. This is Bloomberg.
right, welcome back. I was told I might need to correct myself because a few minutes back I perhaps unwittingly blurted out that I'll see you tomorrow when we're not done with the show, so I apologize. I mean, we will be seeing you tomorrow still, but we have about an hour of programming
he was done with the show.
Yes.
Mart, though, yeah, certainly this rally is taking a bit of breather here today. JPMorgan out with their latest report there, downgrading the stock to neutral there. We've been talking about it quite a bit. Price to perfection, according to them. On the flip side, though, JPMorgan upgrading CATL to overweight, and there you go. The stock's flying here right now in Shenzhen as well as here in Hong Kong. We're up close to 10% for the A shares.
Okay, so in just over 5 minutes' time, we'll be getting the release of some numbers coming through. These are the monthly activity numbers for the month of August, and we are expecting a 5.6%. That's year-on-year in industrial production. Retail sales 3.8%. RBE folks think that's about 2.9% on the lower side of things, and of course fixed asset investments, which I won't have time to get into, but I guess we'll
talk more then.
We'll talk more in a couple of minutes.
Welcome back to the China Show. Here's a look at the CSI, about 3.5 hours into the session here. We're still doing okay. We're 0.5% up here. MSCI China is up also, similar measure. Of course, we are just moments away from this data dump out of China. We did get those new home prices just earlier on. We did see when it came to new home prices, the drop was a bit slower than the previous month. But when it comes to used home prices, that's where we saw faster drops here, Dave. So potentially more urgency for some of these new sort of slightly, the easing of some of the top tier cities as home
Shenzhen being the latest one.
Start actually working now in some ways.
Yeah, the inflation adjusted home price actually was down 2.6% year-on-year. That's for August. So that simply underscores the point Yvonne was making. A couple of seconds, we should be getting the numbers coming through as well. And yep, here they are. And why don't you start?
Okay, it seems like it is a miss for almost all measures here. Just take a look at that. Retail sales, let's start with that. 3.4%.
It's a miss in all.
Which was a miss there and slower than the previous month as well. Industrial production, that brings up print to 5.2%. Also a miss. What else are you watching, Dave?
Yeah, okay, so we're looking at... Okay, so the retail sales year to date. So this takes us from Jan to August. It's at 4.6%. So that's slightly below the forecast of 4.7. On retail sales, to your point, that one actually missing quite substantially. Let me just look at the range of forecasts here. So from 3.8%, that was the median. We came in at 3.4%. So it came in at the low end, not completely missing the mark, completely on the low end of forecasts. Perhaps on the point we were making earlier on as well here, Yvonne, on the weakness still in the property sector, and you are getting, of course, their residential sales falling 4.7%.
Yeah.
Property sales year to date, property investment is down close to 13% year to date. So that's clearly still a drag. Sir, the jobless rate actually ticked up to 5.3% from the 5.2%, which was the prior read, and also the estimates. But yeah, it simply underscores, I guess, perhaps the need to keep the focus on supporting and easing as it pertains to this economy here.
Let's bring in Jing Liu, Greater China Chief Economist at HSBC Global Investment Research. First glance at these numbers, what's your take?
Well, it's actually a big missing across the board. I think all numbers point to the softness in the middle of the year. Probably for Chinese regulators, policymakers who are data dependent, they look at this data and probably will start to think about what kind of extra policies they want to roll out.
What would be potentially new information here as far as potential easing is concerned? Because people have been calling for a rate cut, a triple R cut. Does that come sooner than you think, or what else could be on the table now?
I think a rate cut is possible, especially after the Fed start the easing cycle again. But not so much room for a rate cut, I would argue. Maybe 20 basis point. I think in China it's kind of complicated in the sense that a lot of state-owned banks, they actually need to do a lot of things, not entirely driven by commercial purposes. So from that perspective, they need some profitability to protect such kind of operation. I would argue we're probably close to the lower end of the interest rate. However, I believe PBOC will do more on the liquidity easing perspective. For example, about 2 weeks ago, PBOC and Ministry of Finance actually had the second working group meeting talking about how to coordinate their policy making. So given the recent performance on the bond market as well as the stock market rally, I think maybe the timing is right for the PBOC to start the purchase of the treasury bonds from the secondary market.
Okay. In terms of what's led to this kind of sharp slowdown, I mean, we saw credit was also slowing. Export growth is also falling short of forecasts as well. Where does anti-involution fit into that? Is that starting to show that it's adding pressure to growth now, too, to this economy?
I think not so much yet. We have seen a lot of industrial associations, basically their own coordination, but we also know that kind of coordination sometimes are not the most effective. So people are still keeping an eye on whether we're going to get concrete measures down the road. For the anti-involution, I think in China's history, whenever they roll out the measures to cut the capacity, they usually will roll out also the demand boosting measure. So that's what we are waiting for.
Talk to us about one thing you just mentioned there, bond buying in the secondary market. I mean, there was speculation already going into today. And I wonder, when do you think that's going to come? And do you think we'll get a steeper curve? Because to the point you were earlier making as well on the banks, they will need some incentives to keep lending things out, and a steeper curve does that for you.
Yes, we actually think the resumption of the bond buying might happen in the fourth quarter. Okay. I think last year they did 1.4 trillion in 5 months, and we will see some magnitude similar to that, especially given we will see more issuance of the government bonds going forward. I think that will definitely play the role of steepening the curve, and I think this is helpful for the reflation as well.
What are some of the bright spots still in this economy?
Well, last Friday, Ministry of Finance actually held a press conference, and during the press conference, the officials indicated basically determination to spend more on things related to people's livelihood. So we probably will see more support on the consumption side, service consumption, goods consumption, etc., and also improvement on social safety net. Another thing, probably the market didn't get too excited about is the so-called local government bond, local government debt swap. That was announced last year, 10 trillion. The market was kind of underimpressed because the traditional view was that this is to help the local government, help them to basically lengthen the duration, to lower their interest rate, etc. But this time, I think the difference is that the creditors to the local government tend to be the real economy, the different kinds of enterprises. Like we talk to SOEs, we talk to foreign companies, they all face this kind of problem as well. So if they start to front load next year's 2.8 trillion of the bond swap quota, they can eventually inject the liquidity into the real economy. So that can solve the problem of the overall lower economic velocity. So I think that's quite helpful.
Any early signs of... Actually, let me just set up the question before I ask it. We're almost going into a year since the PBOC came out with that big bazooka. It was almost a year ago when they had the press briefing and they cut rates just almost across the board, live on our shows. And we were
I
kind
was
of
there.
Yes,
you were there.
That's right. That's right.
I remember. Yes.
Well, that's right. Yes.
Yes.
What's changed since then? Very simple question. In what way has the economy improved since that point in time 12 months ago?
To be honest, I think the economy might be facing more pressure right now, especially given the volatile external environment.
Okay.
However, I think when we look at the stock market performance, sometimes people get confused. How come there's a decoupling? I think when we talk to policymakers and investors onshore, the clear message is that this time it might be more stable in the sense that we haven't seen the crazy behavior by the retail investors yet. A lot of the rally seem to be led by the institutional investors' rotation from bond to stock. And also when we talk to officials, they seem to be quite rational in terms of how they want to develop the stock market in the long term.
And it seems like policymakers are somewhat more tolerant of a stronger renminbi. Why do you think that is?
Yeah, that's right. I think basically China is in the middle of the rebalancing. We need to boost the consumption at the same time deal with the overcapacity issue in some sectors. And this rebalancing actually mirror the rebalancing the U.S. is doing. So in the process, probably a slightly stronger renminbi will help in terms of boosting the purchasing power.
Okay. Jing Liu, of course, is staying with us out of HSBC Global Investment Research. Lots more to talk about. We'll be looking, of course, at the property market specifically as well, and I guess where that conversation goes. I mean, just to go mention as well, as we go into a fresh trading week, and we are looking at a fair amount of event risk out there, central bank decisions left and right. 36 hours of goodness, as Yvonne was just phrasing her. Of course, I'm taking the goodness. I'm injecting the goodness there. I think there's a different phrasing that Yvonne mentioned earlier on. And I think as far as Chinese markets go, in case you missed it, there's multiple, there's melt up in PE that you've seen because of the rally, right? So we're now trading at about 12, 13, and effectively that takes us back to about 3-4 years ago, 1 sigma above the median, and of course, at what point do earnings then come in? Now, all that being said, liquidity seems to be enough to deliver this rally so far. CATL is also one that we're tracking going.
We're getting more from this JPMorgan upgrade now. So basically what we're seeing, the 8 shares are heading for a record on the back of what we've been hearing. So JPMorgan upgrading the stock, basically saying strong earnings outlook for the Chinese battery leader on the back of energy storage systems, or ESS demand, they say. So that certainly is what. So they're raising their earnings estimates by 10% of this year and next, to the highest on the street. So therefore, that's why you're seeing the stock doing so well here today. CATL A shares are up 13.5%. So there you go. Price target is now at 530 Hong Kong dollars, 480 for the A shares as well. So that's about 25 and 50% potential upside, respectively.
Okay, well, let's hope they're right. if you're long on the stock, well, I mean, so far you're already 13% of the way into that as well. But yeah, I mean, Wendy Liu, who joined us earlier on shows, of course, oversees broader strategy for JPMorgan, and basically, this is really one area. Battery materials is really one area where she thinks anti-involution has either started to show up and will further show up as far as these markets go. Okay, for our Bloomberg clients, TL Vigo, on your terminals for the latest context, of course, on all the numbers that have come through as well. More on this in a moment. This is Bloomberg. All right, welcome back. Despite the obvious notion that Yvonne and I are perfect, sometimes we make mistakes, and we need to issue a correction is the point we're trying to make here. So earlier we mentioned that the data actually missed all estimates, and the small nuance to note there is that the data points missed consensus across the board on all metrics. It did not miss all estimates, which is something different, of course, which is when you look at the bell curve and the range. And so it didn't come in at the very tail end of the left side if you're a statistical geek. But yes, anyway, it was below the average.
Below the
below
average.
The median.
And yes, okay.
There we go.
Just to clarify that, but yes, every single segment, basically what we saw there, was a miss from the consensus estimates there. All right, let's talk a little bit more about trade talks, of course, and how this all fits into the whole economic picture, right? So U.S. and Chinese delegations are set to resume talks in Madrid on Monday after the first day of meetings covered issues including trade and the fate of TikTok in the U.S. Now, President Trump says the talks are going fine, but that TikTok's fate will be determined by Beijing's actions.
They're negotiating TikTok right now. We may let it die, or we may, I don't know, it depends, up to China. It doesn't matter too much. I'd like to do it for the kids. They like it. I mean, selfishly speaking, I did very well on TikTok, and I got the youth vote.
All right, let's bring in our Chief Malaysia correspondent, Stephen Engel. He's here with us here. So we got through day one. Yeah. What's in store for day two?
Well, probably more trade talks, maybe even trying to push the ball forward on the TikTok issue. And people are asking, well, why TikTok so high on the agenda when, of course, trade talks, national security, which are also discussed, they are more pressing issues, perhaps, to kind of elongate this truce, which, by the way, this 90-day truce that we're in right now is extended until November 10th. So another deadline is coming up. But I think there's just a little bit more urgency with TikTok because there is a U.S.-imposed deadline of this week to get a deal done with China on TikTok to find a U.S. owner. Otherwise, it could potentially be shut down in the United States. It also could be because this trip, or these meetings, two-day meetings, which will resume again Monday morning in Spain, are really laying the groundwork for a potential meeting between Donald Trump and Xi Jinping. Whether that's going to be at the end of October, on the sidelines of APEC, maybe even on the sidelines of the ASEAN summit in Kuala Lumpur or in Malaysia, and then or in between somewhere. So again, there's about 5 weeks or so until the potential meeting, and they're going to be looking for deliverables. What can Xi Jinping claim victory about with Donald Trump at that summit? What can Donald Trump claim victory? Could they come to an agreement on TikTok? I would say that's, even though it's going to be a very difficult deal to happen, Donald Trump has already indicated he's willing to let it die. But if they can find some sort of agreement, that could be something that both sides could claim some sort of victory, that they reached consensus, they got a deal done, TikTok stays alive in the United States. But I'm getting ahead of myself.
Well, I mean, it could have actually gotten off to a rocky start because it is separate news, but related certainly, that China was looking into chips. What do we know about that specifically?
So the Ministry of Commerce has announced in Beijing essentially two new investigations, one into anti-dumping allegations against the United States for analog IC chips. They're not the cutting-edge chips technology, but they are in many different products, from smartphones to EVs to medical imaging devices and many more. So we'll have to watch this and see how this affects. But these are the kind of products that are sold by Texas Instruments and also Analog Devices, a couple of companies in that space. The other one is a broader investigation, sort of an anti-discrimination probe into the White House's policies towards China on its own domestic chip companies and whether it is a discriminatory actions by the United States to forbid the sale of chips like NVIDIA to China. So we're going to definitely watch this one. But it's interesting because it came on the eve of those talks in Spain, could have kind of gotten those talks off on a rocky start because, as well, the United States added 23 Chinese companies to its entity list just the day before that, too. So tit-for-tat action by the U.S. and China.
Weekend, but news never sleeps. Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent there. Now, as far as the data goes, so we're getting more context on this slight tick up in the unemployment rate. So the National Bureau of Statistics is commenting that the unemployment is up slightly because, incorrectly, it is graduation season, so perhaps more people coming into the labor force. Context is really key here. Let's bring back in Jing, of course, still with us here on set, Greater China Chief Economist at HSBC Global Investment Research. What's the external picture looking like for China? Because you mentioned, things actually would have been doing better were it not for the tariff conversation, but this is the situation we're in. How do you think exports will hold up in the fourth quarter, given everything that Steve was just pointing out there?
Well, I think for the remaining of the year, export will look more difficult because the export was supported by not necessarily China's front-loading export into the U.S. because we see the number actually keep dropping over the past several months. But at the same time, before the August tariff on other nations finalized, we do see in other countries they actually had this front-loading kind of activity.
Yes.
And through that, some of them might need to import the intermediate goods, capital goods from China. And some people suspect there's some transshipment, but I don't think we have smoking gun evidence one way or the other. Going forward, I think basically the payback of the front loading for all economies going into the U.S. And recently we see the U.S. survey suggests that the consumer sentiment seem to soften a touch. I think those will add pressure to the export going forward.
I think our team has been talking about in this data that the slump in investment, which might be the big surprise, only half of 1% so far this year, which they say is actually the second worst result on record, only exceeded by 2020, which is the first year of the pandemic. Why do you think that's? Do trade tensions factor into that on why we see this slump in investment? And are there any policies that need to be put in place to really spark a recovery now?
I think August we did see some extreme weather condition in Hong Kong. We got quite some black rain, I remember, and definitely the
more than a few black rains.
Yeah,
the Greater Bay Area, and one of the production base actually was hit the same. So that plays some role in extreme weather condition in other parts of the country as well. At the same time, the uncertainty on the trade side actually put a lot of entrepreneurs and business owners on hold. They want to have a clear picture before they make their move. I actually heard quite some of the executives saying that as long as they have certainty in terms of what the future tariff map look like, they'll work it out. But they just couldn't afford rejigging their supply chain every other year. So this uncertainty has actually got a lot of people, and I think that's reflected on the investment as well. And obviously anti-involution and also the kind of trying to ring in the local government's behavior, especially in providing certain kind of incentive, preferential treatment in trying to getting the business set up and invest. That might play a role as well. And property, this is an old topic we have been discussing for the past several years.
Yeah, 24 plus months now, I believe, of the property story. Are there any early signs that inflation expectations specifically are starting to become anchored from the downside?
I think the August PPI month-on-month data hitting zero. That one actually is a bit surprising to us because when we look at the previous round of the supply side reform, actually it took 3 months between, let me take it back. Took 3 months when they announced they're going to engage in the capacity reduction.
Yes.
And then we finally see the PPI month-on-month flip to zero. But this time they said it in July. People take it seriously, and August, the expectation already lifted to the other side. And actually recently I got some questions from my institutional investor. They asked me whether I worry about China exporting inflation. This is probably way ahead of curve, but if the anti-involution, if it plays out, China might be going to the inflation side next year or the year after.
And when do they, you think, start to export inflation? So if it's 2 years down the road where inflation comes back, when does the rest of the world need to start looking out for any signs of that? Is that?
I think it will be 1 to 2 years down the road. Okay. We will need to see the concrete measures on the anti-involution sector by sector, and then when those get filtered into, I think we will start to see the reflation.
Jing Liu, thank you. Greater China
Fantastic.
Chief Economist at HSBC Global Investment Research. We got plenty more ahead. This is Bloomberg.
All right. It's a big story when we talk about it because we don't normally do it. The Hong Kong dollar, which obviously is a peg, is actually moving quite a bit within, of course, its bounds, and we're looking at some strength coming through there. And a lot of it also maybe has to do with the fact that the Fed's coming up, positioning ahead of that, strengthening, as you can see, quite visibly. Watch HIBOR in the next hour around this time, because this one has actually come back in a big way from about 1% in early August to now north of 3% right now. Plenty more ahead. This is the China Show.
All right, welcome back to the China Show. Here's a look at the HSI, how it's doing here today. Of course, that press briefing in Beijing with the Bureau of Statistics is going on to as well. After what we saw when it came to the August activity data, where basically, every sort of segment was basically missing consensus estimates there, and quite steep as well. I think how fixed asset investment was only 0.5% this year as well, and retail sales and the like all really missing the median estimates there. So certainly a lot of questions from the press here this morning.
Yeah, and more context coming through, right? So on the unemployment rates, the NBS is coming out and saying it is graduation season, hence, of course, what was behind that uptick in the unemployment rate. As you can see, markets initially weekend off highs, and as you can see, we're bouncing back in, and of course, we're up 0.3 to 1%. I've yet to actually look at index constituency at this point in time, about an hour into the session. Just keep in mind also, we're coming off the best week on MSCI China going back about 6 months or so, right? So the tide has certainly turned. Momentum is still there. I think we're now looking at 12 days, not Christmas, not just yet, 12 days of net southbound inflows. There we go. Going into, it was 11 going into today. It should be 12 right now if this continues. Asia Pacific, ex-Japan, because Japan is, of course, shut today, although, of course, you are seeing a flat move there. S&P futures, and I believe we have a central bank decision this week, which we've talked about, so I won't spend more time on that. As far as sectors go, yeah, that looks to be evenly split across that. Your big potential catalyst would be if the Fed gives us reason to sell the dollar off, then that might provide a further platform for risk assets on which to rally. Okay, let's get more context on what's going on here across these Chinese markets. About an hour into the cash market session, Winnie Xu is with us here, our Asia Equities reporter, to talk us through what's the coverage like today. What are you guys looking at?
Yeah, you really see that the market is brushing off all these weak data, but actually we saw something very similar just last week when we had the weak CPI data, right? So it really seems like right now, less kind of focusing on the fundamentals and more on these sectoral factors, especially with the hype around the AI theme right now, and that has really pushed markets higher last week. So that still continues to be what's likely to drive the market further at this point, whether it's, yes, the optimism around that front or that liquidity that we talked about just now about the very strong southbound inflow, as well as foreign investors' interest, right? Last week we talked about how Morgan Stanley sees the highest U.S. investor interest in Chinese stocks since 2021. So overall, the sentiment, whether it's for the global markets, translating into Chinese market, expectation for the Fed to cut rate and hence more room for the PBOC to cut, that has all been like kind of supporting the markets here, whether it's offshore or onshore in China. And yeah, less of kind of the concerns around the macro weakness. And actually on the flip side, maybe expecting more stimulus and more consumption on that front because of the weak macro.
Tell us about Mart, because JPMorgan seems to be really driving a lot of the price action with not just Mart today, but also when it comes to CATL. Let's focus on Mart.
Yeah, exactly. So, they're cutting the ratings here right now, talking about the lack of stimulus, the lack of catalyst. And I think that really reflects kind of the broader rotation that we're seeing right now here in China. Yes, we're seeing lots of stocks really have been surging in the past few months, weeks on these topics, whether it's the new consumption trade, whether it's the anti-involution, and these big themes driving the stocks up so much. And we're kind of in this kind of consolidation phase right now that the overall market has rallied so much. What are we looking for next, right? Yes, we talked about overall weak macro, but actually we have that catalyst coming up in October, the fourth plenum that people are looking forward to. So ahead of that, we are likely to see just some overall profit taking off the stocks that have risen a lot, but also investors looking into the new pockets that they might be seeing some opportunities, especially with the AI front and the potential policy of pushing for further innovation. So yes, we have a set of weak data that came out today, but the focus right now is really turning to what set of new data we might see for third quarter GDP in October and the set of high-frequency data in September to help investors gauge if this weakness in the overall macroeconomy is likely to continue or not.
So we talked about Palm. Can I ask you about BYD? $45 billion wipeout. We're not trading at 108. I think we hit a low almost of about 100. If I could ask my producers to bring up chart 1043, tracks consensus ratings, and we're coming off highs there. We're now looking at a 4.5, which effectively looks at now the split of analysts who are bullish in the stock is, well, still bullish, but not as bullish as before. What can you tell us?
Right. So actually we saw the Hong Kong listed shares actually tumbled more than 30% from that all-time high from about 4 months ago.
Yes.
So the pressure here right now is that price competition, right? So we saw actually from earnings as well that the stocks that have been struggling with this type of price competition have been really struggled to impress investors as well. So again, that speaks to the broader situation here that there is a split in terms of kind of companies that are able to monetize AI, able to show that in their profit margin, and companies or more traditional ones that continue to struggle with that ongoing price competition, whether it be in the EV sector or food delivery. And that divergence is starting to emerge more and more as we can tell from the 2Q quarter earnings. So we are likely to see investors to continue to kind of shift money away from industries or companies that cannot kind of keep up with adding their value or to boost their development in AI, and shifting away from those that struggle with price competition.
Wendy, thank you, Wendy Xu there, our Asia equities reporter, on what things are moving in the China's market here today. Well, staying in the EV sector, as Wendy had mentioned there, China says it also plans to stabilize growth in the automobile industry amid rising competition and insufficient demand. That's according to a statement posted by the Ministry of Industry and Information Technology. Let's bring in Katrina Nicholas, who leads our Asia transport coverage here. On what more do we know about the stabilization plan and whether it's going to work or not?
Well, I think that's the interesting point, because if you look at the dynamics that have been playing out in China's EV sector for almost the last 3 years now, we've had this continuous intense price competition. You know, it really kicked off in early 2023. Tesla was leading the charge back then. Since then, you would have to say BYD has really been the culprit. They've been leading this price cuts after price cuts in the market. Paradoxically, you'd think that would be encouraging for consumers to buy EVs, and there has been some of that. But also we've seen consumers go, you know what, if the price is going to be just a little bit cheaper next month, I'll hold off. I was sitting on the fence anyway. I'm not going to buy an EV just yet. And so you've also seen weakening consumer demand. At the same time, there's a lot of overcapacity in China's sector. There are factories that are just not being utilised to the extent they are. And so against that backdrop, the government is trying to step in to stabilise the market. So you're seeing initiatives like cracking down on advertising. There's been quite a lot of exuberant advertising about what EVs can do and autonomous driving, and so the government has really ratcheted that back, dialed that back. They're also looking into things like EV insurance, making it easy for people to insure their cars, because often insuring an EV is more expensive, the premiums are higher, and also really trying to encourage EV uptake in rural areas. Because if you think about Beijing or you think about Shanghai, EV adoption rates there are quite high, you know, 50% of new car sales sometimes. But in the rural areas, and there's vast amounts of those in China, EV uptake is not so pronounced. So that's what I think these measures are trying to do.
I mean, separately, but on the same broader industry, what is this about Hong Kong pitching itself to be some production hub, some sort of production hub for EVs? What do we know about that exercise? This
is really interesting.
It is.
Against this backdrop of a huge amount of overcapacity in China, why would you want Hong Kong to suddenly be spitting out more EVs? I mean, to my mind, it doesn't make a lot of sense. I think what we're hearing is that it will probably be a final assembly line if something happens like that in Hong Kong, so you're not going to see a massive, production factory from go to woe, which of course requires an immense amount of auto suppliers around that. That's a huge investment, takes many, many years to get these things up and running. So I don't think that's what we're looking at in Hong Kong. Potentially it's more of just a final assembly. Maybe some automakers are thinking they could use Hong Kong as a beachhead to export into other parts of Southeast Asia. But again, I come back to the overcapacity that is already, a big, big problem in mainland China. Yeah. It's curious to me why they would want to encourage this.
Katrina, nice to see you, by the way, here on set. Katrina Nicholas there, of course, who leads our Asia transport coverage on both those two stories. Okay, the other piece of news, of course, which came out this morning was Tencent, and we understand that Tencent has now appointed banks for potentially its first bond offering in 4 years. The move certainly comes amid this increased fundraising activity in the tech sector. We talked massively about Alibaba last week. Robert Lee from Bloomberg Intelligence is here with us to help us understand this window of opportunity. Raise money when you can and not when you need it, as they say.
Yes, I think the expression is feed the ducks when they're quacking. Given expectations for reduction in rates led by the Fed, as you said, and with strong equity prices, it's a fantastic environment to raise debt, particularly if it's a convertible bond. Although in contrast to the CB that we saw issued by Alibaba last week, Tencent is announced plans to issue a series of more conventional bonds up to a total value or cumulative value of around $30 billion over the next 12 months.
What do you think the proceeds will be used for? And does Tencent really need it?
Yeah, I'll answer the second question first. Yes, it's a highly cash-generative company. They tend to keep a more neutrally geared balance sheet. So by that, I mean their debt roughly offsets their cash reserves. So, from an accounting point of view, that's more of a neutrally geared balance sheet. And I think given they are inherently cash generative and throwing off a ton of cash at the moment, plus obviously with recent repayments, then I think what they're announcing today should be seen in the context of ongoing, good fiscal, prudent financial management of the business. But the obvious use for the proceeds is obviously AI. Particularly on CapEx related to their data centers. I think most of that will be focused on internal usage and on consensus numbers this year. Just to give people some context, Tencent will invest around $15 billion in CapEx. So this $30 billion placement, assuming it happens over the next 12 months, will go towards funding that.
I mean, similar to, I can't help but think about how Alibaba is doing the same thing, and it's sort of, in your mind, which one is a better company that's a better position to take advantage of AI?
Yeah, we're just tying into the conversation you've just had on EVs, and as you've heard me say once or twice before, they're all doing the same thing, aren't they? So there's a lot of capacity on the AI front going in at the moment, both from the data center side and also with ongoing investments in AI. So there still remains a huge question mark as to how these companies will differentiate themselves and monetize in the long run. But I think Tencent's strategy in AI, in contrast to Alibaba, is lower risk. They're looking to utilize AI internally to drive cost savings and synergies across their business. That's more likely to generate near-term returns. I would say Alibaba's strategy, more focused on external clients, is more speculative in nature, particularly as they're gunning for AGI, so artificial general intelligence, which is, I think, as I've said before, I don't think can be achieved with the current generation of AI models. And as we've seen with Alibaba as well, top-line growth in their cloud intelligence business is very strong, but there's a lot of margin pressure there. And again, we're arguing that the potential upside on cloud intelligence at the bottom line is not big enough to move the needle at a group perspective. Alibaba's earnings remain driven by e-commerce. And as we know, again, overcapacity, there's a lot of competition there.
All right. Robert Lee, our Bloomberg Intelligence senior analyst. But the stock's still up another day, 3.8%. You're watching how long it's actually been up, Dave. Yeah, so we're now up 7 days. Longest win streak for Alibaba going back to 2020, July 2020. So it's quite a run, $155 a pop. Okay, plenty more ahead. This is the China Show.
Right, this K-pop story keeps giving. The win streak now, as far as the South Korean Kospi Index is concerned, is now extending to a 10th session. Yep, double digits now. Longest win streak going back about 6 years or so. And perhaps the news this morning on the encouraging side of things, this decision, of course, to abandon the plans around the capital gains tax, perhaps furthering the case for the bulls. It's certainly the first major policy reversal from the president since he took office back in June. Let's bring in Yukyung Lee, our stocks reporter, to help us understand what this rollback actually means to the politics at play here, Yukyung.
Yeah, sure. So this was the major first policy reversal we've seen since the President Lee Jae-myung took office in June, and it highlights the challenges for his administration as they try to meet competing demands, conflicting demands, including the political commitment to this Kospi 5,000 campaign they had during the election, and also they have this growing need to increase tax revenue because they have passed the stimulus measure and they want to give more consumption coupons to boost consumption in South Korea and to counter the slowdown, economic slowdown, perhaps hit by the U.S. tariffs. So all these show some of the challenges that this administration is facing. But clearly, the drop of the plan shows that it seems like the market is reading the commitment from the administration to continue forward with their earlier pledges to lift the stock market so that the benchmark Kospi can reach 5,000 through corporate reforms and some of the more market-friendly measures from the administration. So we're seeing some of those proxies of those reform measures also rising, such as the holding companies and the local brokerages that can benefit from more inflow and turnover by the retail investors. And one thing I also want to highlight is that this reversal also shows this power of retail investors, the 14 million, about a third of the local household, like how much influence they have in this $2 trillion stock market is clearly shown in this move by the government. It seems to be representing both the risk and the opportunities for Lee.
Yeah, they call them the ants, right? These retail investors that make up, 2/3 of daily stock market turnover in this market. Tell us a bit more about that. How influential are retail investors in this market?
Yeah, so they are definitely one of the core voter base for South Korean politics. The 14 million out of this 50 million population, they are the ones who have skin in the game, and that's why they were really strongly opposed to this when this tax plan was announced, which they fear will spark further sell-up. So one of the complaints was that South Korean stock market has been consistently trading market, not the type of the buy and hold market. And if the government goes ahead with this plan, they will see severe sell-off from the super ants or the investors holding large amount of stocks in the local stock market, selling their holdings to avoid paying more taxes at the end of the year. So with this plan withdrawn, it seems like they are relieved for now. I mean, overall though, it's been the foreign investors who have been driving this rally in the Kospi so far. So the retail investor has been a little bit hesitant. So we'll probably see in the coming month whether this move will bring this domestic investor back to the local equity market and could add more fuel to this rally, more than 40% so far this year.
It's been amazing. Yukyung, thank you so much. Our Bloomberg Stocks reporter, Yukyung Lee, there joining us out of our Seoul bureau. In some other news this morning, we're watching very closely sources saying that Tencent has recruited a prominent artificial intelligence researcher from OpenAI. The Chinese firm is said to have hired Yao Shenyu to work on integrating AI into its services. His LinkedIn account says he has worked with OpenAI and Google. Now, firms have battled fiercely for talent this year, and this would be one of the most high-profile defections from the U.S. to China. Apple has delayed the launch of its iPhone Air in mainland China due to what it calls regulatory approval issues. The company's China website on Friday displayed a message stating release information will be updated later and that all models will be released after approval. Apple previously said the new product would become available for pre-order from September 12th. And Sony's Demon Slayer has set a new box office record for Japanese anime in the U.S. and Canada. The film brought in $70 million and surpassing the previous $31 million record set by Pokemon in 1999. Based on a Japanese comic book series, Demon Slayer has already grossed about $280 million worldwide going into the weekend. I thought we were talking about K-pop demon hunters, but no, this is another demon sort of movie.
Yeah, leveraging on the name, which is something.
Anything demon related, I think, is doing well.
Yeah, well, upside, certainly not downside there. Looking at that. Kimetsu no Yaiba, I think. I'm looking at the internet now for that, but pay no attention to me. Plenty more ahead. This is Bloomberg.
I think when we talk to policymakers and investors onshore, the clear message is that this time it might be more stable in the sense that we haven't seen the crazy behavior by the retail investors yet. A lot of the rally seem to be led by the institutional investors' rotation from bond to stock.
Given that institutions care about macro data, care about EPS, so I think this sort of a rally will be more step-like, be calibrated on the fundamentals. So I think it's becoming a more mature market.
Wendy Liu from JPMorgan and Jing Liu from HSBC there speaking to us earlier about this recent equity rally. And really, it's not because of the herd mentality. It's not because of the retail participation this time around.
It's not Korea.
And this makes it a little bit more long-lasting, this rally, potentially.
Yeah, it's different this time around. And I think one of the phrases that Wendy used there was in 2015, the retail investor was unshackled.
Unshackled, yes.
And now they're shackled in a way because they tend to come in at the end of the rally.
Yeah.
Because if you prevent them from coming in a big way, that might the joke was it might then, prolong the bull market. At some point, though, valuations need to matter. And I think the other point that Wendy was making earlier on was on the global investor, right? That the big picture, some seem to be missing the big picture in China. They're looking for growth. It's not a growth play. As it used to be.
Yeah.
It's thematics, it's all these little trades, these opportunities onshore that people need to be paying attention to.
Maybe don't be so obsessed with the macro picture, which, as according to what we saw in August, which continued to show a sharp slowdown once again, right? When you talk about every single, the segment was basically missing consensus estimates there by a substantial sort of drops too. So certainly that is some ways showing that nothing really has quite changed on the macro front in some ways, but maybe adding more urgency for more stimulus, right? I think there's a lot of chatter now. The government might have to step in the bond market, for example, and start buying to stabilize the bond market there, just given the equity rallied as well.
That's what HSBC said, because rate cuts don't quite do the same job in China as they do in other parts of the world, right? So that might lead to a steepening in the curve. And by the way, the fact that China's yield curve has not steepened as much as its peers is probably also one of the reasons why the equity market has done well. NI space Checo, CHECO, is a function you run for a client to get an update of the Chinese economy. And I'm looking at that specific screen right now because you are getting some lines coming through out of the National Bureau of Statistics, commenting on addressing disorderly competition, and also commenting as far as the CPI is concerned that factors driving CPI are expected. They do see some visibility around that, of course, turning to the upside. Okay, very briefly before we turn the page, and I'm correct now, I'll see you all tomorrow. A brief look at markets. We're looking at HIBOR in the next hour as this one visibly has picked up from the lows that we hit back this time last month. We're now north of 3%. Plenty more ahead here on Bloomberg Television.